You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. And hey, are we witnessing the shortest stock market correction in history? Or is there more to come? And transitory, intransitory, non-transitory, intransient, permanent inflation? Or do these economists at the Fed have it all right? Well, let's find out from Avi Gilbert. And Avi, frequent guest on the show. And if you got a question for myself or Avi, please send us an email to kl@kerrylutz.com. And Avi, your site, ElliottWaveTrader.net, highly recommended. So let's get into it, Avi. It's great to have you back. So first, stock market correction, more to follow, or is this it?
Well, let me give you a little bit of background before I answer that question specifically. I think the last time you had me, I was calling for a rally in the market to take us up to minimally 440 on the SPX, with the maximum I would expect is about 4,600. And then I was looking for a pullback to a specific target region from there. We know right now the market topped around the 45.50 or so region, and the pullback target that I had was 41.65 to 42.70. So far, we have now hit the minimum of that target. So what I'm looking for as we speak, the market is rallying. I mean, I think we're going to get closer to the 43.80-ish region right now. But if we do get up into the 40.80, 40.90 region, and then we see a corrective pullback, and then we rally back up over whatever high we make in the next day or two, that is what is going to tell me the likelihood that this pullback is over is high. My next upside target is 4,900. However, if the market does not pull back correctively from whatever high we make in the next day or so, and instead drops strongly below, I would say even 43.20 or so, that's going to put us back on track to now look towards 42.60 to 42.30 to 42.60 for one more test of support before we try it again. Mm-hmm. So right now, I'm just waiting for the signal that I can say, great, this looks great, guys. Let's start getting a little more aggressive on the long side. My next bigger target is 4,900 into probably around the first quarter of 2022.
Okay, so that's interesting. And as usual, Avi, you are the contrarian.
I mean, I can't help it. I have to go with what my charts are telling me. I know. I mean, this happened back in March of 2020 when I said, when we were hitting 2,200, and I said we were looking for a rally to at least 4,000 from there, but more ideally 6,000. I can't help it. I have to go with what my charts are telling me.
All right. Well, the charts call the direction of the market, and let's face it, we know from the past that your charts are often correct. Not always. You don't have a perfect record, but you got a pretty darn respectable record, don't you?
Yeah, we are not perfect, but yes, our numbers track us north of 70% of accuracy.
Well, look at it this way. When you're looking at sports betting, right? In sports betting, if you could get 55% right, you'll pretty much break even with the VIG from the bookies or the sports book if you're a legal bettor. So 70%, if you could do that at the track or with sports betting, you could do quite nicely, couldn't you?
Absolutely. I just wish I knew how to chart things on sports betting. Doesn't work as well.
Well, there's your next career opportunity here. Right? Everybody will be knocking down your door if you could figure that one out, Avi. But in seriousness, so we're not gambling here. We're talking about speculation, but we're not even talking about pure speculation, which is the equivalent of gambling on financial markets. We're talking about getting an edge. So when you do place your bets, you're placing an advantage bet, which the casinos throw you out if you can do that there.
Correct. And we use risk management based
Yes.
on our structures. So those are the two, we want the probabilities on our side. And even so, there's always, even if you have a 70 or 80% probability for a trade to work out, there's still a 20 or 30% chance it won't work out. And you have to know where to cut your losses in a reasonably small fashion.
Kind of like a marriage, like a bad marriage. It didn't work out. You got to learn. You got to know when to hold and when to fold and when to run, right?
I have never used that as an example, but I hear your point.
Hey, well, life is fraught with risks, right?
Absolutely.
You walk out your door in the morning, you don't know if you're going to be walking back tonight, and we can only hope that we can play the odds. The odds are pretty good that unless you're suffering from a real bad condition, your odds of not coming back are kind of nil, right? So what about the markets here? We're like really looking at energy. Energy has been pretty amazing, right? The returns in the energy patch, pretty incredible, aren't they?
No question about it. I mean, I'll tell you, I was pounding the table last fall, and I told my members that this is the first time I'm going overweight the energy sector in many, many years. And they have been thanking me ever since.
So, and energy, it's been so cheap for so long, right? For so many years, everybody just thought it would keep on going the way it was going, right?
Yeah, absolutely.
And now look, energy, if you're in Europe, it's a real nightmare, isn't it?
I don't know. I don't track Europe very often.
Yeah, well, we do. And we've seen it. It's been shocking, to say the least. I mean, it's really problematical for what's happened here. So, hey, but let's look at energy here. What's happened here, and what do we need to know about it going forward?
Well, right now, I'm looking for. We're still expecting a little bit more rally over the next couple of weeks in the complex. But I think we could start seeing a topping process over the next couple of weeks, and then a more sizable pullback in the oil complex. So that's what I'm looking at right now. Okay,
the big energy issue lately has been natgas, Henry Hub, and we've seen it go over $6 per million BTU several times here, right?
I'll be honest with you. I don't personally track nat gas myself. I have a commodities analyst that tracks that specifically, so I really haven't stayed on top of that very much.
Okay. All right. So oil. Let's go to oil. You think we're going to be seeing a topping in oil? What do you think the peak number is for oil?
Well, I don't think it's a peak, because I think all it is going to be a pullback. It's going to be a healthy pullback afterwards.
Okay.
But for example, I'm looking at the USO chart that I track for my members. They love the ETFs. So, I'm looking at somewhere around 58 to 60 or so. As we approach that, I'm looking for a general topping region, but only for a pullback. Like I said, it could take a couple of months in the pullback, but I'm looking for a pullback, and I think that will only set us up for much higher levels as we look towards 2022.
Any idea what the peak's going to be when we do peak and when it'll happen?
I'm pretty sure you're going over 100 on the WTI.
Really, over 100 on WTI, and that will have effects on the economy, won't it?
I mean, I've seen the argument on both sides. One argument says, well, higher oil causes more of a lag, drag on the economy, and then the other side says, well, higher oil means the economy is doing well. I really can't buy into either one. I look at what oil does on the oil chart. I look at what the market does on the market chart. And I really don't even care about the economy as much, because the economy really lags the market. So, ultimately the economy follows the market. As the best example was when we were looking to go long at 2,200 on the S&P 500, all the way for the first 1,500 points off that low, economists were saying we're still in a recession. I'm looking at this and thinking, damn, we just made 1,500 to 2,000 points on the S&P 500, and we're still in a recession. Well, keep me in a recession if this is what you think. But I really don't pay much attention to the economy. It lags the market and really is useless to me.
Okay, so that's that old thing, the difference between a depression and a recession, right? A recession is when you're out of work. A depression's when I'm out of work.
When I'm out of work, exactly. Exactly.
But it's seriousness. So do you really think that the economy is still being led, or the leading indicator is the stock market, or has it changed?
I've always believed the stock market is the leading indicator. And when you take a step back and you try to understand why that's the case, it really makes sense when you look at it from that causality chain. For example, I look at it and say, when things have become so negative that there really is nobody left to sell, at the end of the day, you're hitting a wall, a negativity wall, and there's only one way you're going to go. And that's when market sentiment turns in the opposite direction and leads us up. Now, when that sentiment turns off of the extreme lows, the extreme negative sentiments, people will act in a more positive way. How do they do it? Well, one way they can do it is they can put money into the stock market. So you see the stock market rallying off a low that quickly when we hit a negative extreme. But when you look at the economy, when that same turn from negative into positive occurs in the economy, well, people now have to go out, acquire loans, buy more product, hire more people to provide services. Then they actually may manufacture the products or develop the services. There is a big lag once that same positive trend changes in the economy. And that lag is why the economy lags the market. When people feel positive, it's very easy and very fast for them to turn that dial and put money into the market. That's why markets lead the economy off the lows 100% of the time. So when you think about it from that perspective, it makes a lot of sense, about that causality chain.
I gotcha. And it does make a lot of sense. I agree with you there. But on the other hand, there's this meme or theme in the economy that as the real economy goes down, Wall Street keeps getting better. Do you think that's happening?
Don't just survive, thrive. The Financial Survival Network.
Today's show is brought to you by GR Silver Mining, ticker symbol TSX, GRSL, OTC, GRSLF, and their website at grsilvermining.com. The company is extremely well capitalized, currently has a resource of 40 million ounces of silver, and is looking to triple that number in just the next year alone. Its management team is first rate, headed up by Marcio Fonseca, a geologist with vast experience in mining operations and the financial sector as well. With all this going for it, and with silver trading over $25 the ounce, there's no telling how high GR Silver Mining will go. So go to grsilvermining.com to stay up to date on the latest developments and get on their notification list today.
This is the Financial Survival Network, the information you need to thrive now more than ever.
I think it's a misnomer. What's happening is, there is a big wealth gap, and that wealth gap is increasing. And as that wealth gap is increasing, we can look back towards, for example, the history of right before the French Revolution, and it really portends what I'm seeing down the road over the next decade or two, where we're going to hit a real bad wall in both the economy and in the market, because I'm foreseeing a major bear market starting up in maybe about 2-3 years. And I think that could be a decade to multi-decade bear market, something we really haven't seen, something similar to what Japan went through. So, when you have that I guess, that divergence, and the divergence increases as it has been between, the wealthy and those that don't have, well, you're going to hit a wall. And I think that's where we're going.
Mm-hmm. So let them eat cake, off with their heads, and may the best tyrant win, huh?
Pretty much.
Well, you're a breath of fresh air here, Avi. I got to tell you. So let's.
Hey, look, I'm still looking for 6,000 on the S&P first, so I'm still a bull, right?
Hey, isn't it really an inflation play? The market, isn't it?
I genuinely don't think so. There are a lot of things that are suggestive that inflation really isn't what everybody is making it out to be. I mean, everybody goes to the store. They look at the prices they're having to pay. They look at the prices they have to pay at the pump. They look at all the different things they have to pay for. And, prices are going up, but in certain aspects of the economy. But when you look at the purely economic definition of inflation, I mean, it really is that, all prices should be going up because there's this huge influx, a huge increase in the money supply. Right. Well, we have a large increase in money supply. That's true, but we have no velocity of money. We're not seeing that huge increase in money supply is actually making it all into the economy, which tells me, well, we're seeing higher prices, but the higher prices could really very well be due to a lot of the supply dislocations we're having due to COVID. So I think COVID really is masking the true issues at hand. And I think when people are now preparing for quote unquote inflation, I think it's going to be deflation that's going to hit them on the back of the head in about 2-3 years, and they're not going to realize it. But there are certain aspects of the economy that are suggestive we're not dealing with inflation. Bonds are not supposed to rally during inflation. Gold is not supposed to be dropping during inflation. The price of lumber hit its high and came down hard. That's not indicative of inflation. And we have many charts like that throughout the market that are saying the same thing.
But wait. Like lumber came down, but it's still double what it was a year ago. So it didn't come down that much. Because
there's still price dislocation due to the COVID shutdowns. And that's what I think really is masking the true issue. That's because I'll tell you, if you look at a chart of the velocity of money, it's sitting on the floor.
Yeah, well, I think there's reasons for that as well. But we just had huge amounts of currency units minted up out of thin air, passed out helicopter money. Literally, Ben Bernanke's ski on there, Jerry Powell just dumping the money out of choppers. Next, we're going to have a digital blockchain Fed coin, and then they'll be able to give you money and say spend it by such and such date or forever hold your peace. And then we've got oil. Everything is getting more expensive here. Even the stuff you can find. I don't know if you eat steak or not, but the new thing, instead of let them eat cake, could be let them eat steak, because you know what? The price of steak, even cheap steak that doesn't taste all that great is out of the ballpark. And then we got weather issues. We got volcanoes. We have all these things. So I appreciate your backing up the Fed with transitory inflation, but you know what I say? I say the best things in life are transitory.
Well, I'll tell you, I'm no fan of the Fed. Let me state that straight out. I am definitely no fan of the Fed, and I think once we go into this deflationary cycle that I'm expecting to start in a few years, I think it could end with the Fed finally disbanding. But that's a whole other theory. But so I'm no big fan of the Fed. But at the end of the day, I think there is a lot of evidence that does support their transitory perspective. Now, at the end of the day, to me, it makes no difference. We're arguing about an economic definition. That economic definition is not going to help me make money in the market.
Right.
So, one way or another, to me, it really is immaterial.
Gotcha. Okay. Hey, I appreciate that. And I appreciate the view because it's a different perspective. And as Mark Twain said, it's not the things you don't know that cause you problems. It's the things you think you know, but you're wrong about.
So true. So true.
And that's what's done it before for me. What about gold here? What's going to be with gold?
Well, I'll tell you, I've been very disappointed with the action of gold. And I had it expected that it was going to rally much more significantly rather than getting the pullback that we've been seeing. I mean, let me pull up my GC chart, because it is definitely not doing what I wanted to see. But I will also say, with a caveat, it has a nice setup to finally break out again.
Mm-hmm. Hey, well, looking at the chart, both times it got slammed down big were quad witching hours. I don't know if that means anything to you or not, but it's indicative of something, I would think.
Not really. I think may have been just coincidence. I don't believe it really has anything to do with the quad witching.
Quad witch?
People are going to buy it and sell it based upon what their sentiment is, and for me, the setup right now is in place that we could see a sizable rally. But I'm telling you, my biggest issue, and I'll tell you, when I'm looking at the metals complex, my biggest issue are the miners. And
yes,
when I look at GDX, I mean, I went short GDX several months ago, and I know many people thought I was crazy to do it, but the setup was such that we were looking down. And right now, the market has an opportunity to bottom here. And we're going to need to see a very strong rally. And we're right below that. My initial resistance is 30.25 to about 30.50. And if we cannot see when I call an impulsive structure, a 5-wave Elliott wave structure that takes us through that minimal resistance, I mean, that opens the door to test 27 and even as low as 25. So I think we're at a very important juncture right here. It has an opportunity to bottom here. If it doesn't, there could be a lot more pain in the complex.
Mm-hmm. Interesting. Well, it could go either way here. I totally agree with you on that. I think the quad witches, coincidentally or not, something's happening there with the quad witch, but I'm not sure what, and I don't pretend to know everything about this, but I do think there's something going on here for sure. So, hey, where do you think, which markets provide the best risk reward function here?
Well, I'll tell you, there are two markets that I really like. I really like the IWM. I think we're setting up to potentially outperform in the IWM again. I could still see one more bout, just like with the SPX. I could still see one more bout of weakness that we could see in the IWM. But ultimately, as we look to early 2022, I'm looking for a target on the IWM of about 260 or even higher. So the IWM has a nice opportunity to outperform. And the other one that I'm looking at for a really nice opportunity is the emerging markets, the EEM ETF. Mm-hmm. We've had a target of about 48 to about 49 or so for quite some time for this to bottom out. And we're just about there, and we're already starting to leg into some long positions on it. And stops are just below the main pivot support we have around 45. So there's a very low risk, but the reward I'm looking at is at least 67 on the upside.
Really? That's pretty substantial. So the Russell last year was the leader of the market. Yep. It's been lagging this year, and you think it's going to reassert?
I think it will reassert once we finish with this pullback. Yes.
Okay. All right. Well, that's reasonable. All right. So what else do we need to know? Anything else that you think is worth following here?
Well, it looks like the dollar is going to be getting a little bit more of a rally. I think we could see the Dixie heading back up as high as 99 or so, 99 or 100.
Really?
Before and then we'll see a sizable decline from there. But I think there's potential for the Dixie to rally here as well.
All right. Well, that's an interesting take on it. I don't doubt that you're right. It seems that it has been, it seems that it's been forming. It was consolidating slightly down, and now it's definitely picked up.
I'll tell you, I'm not highly confident. It's not something I would go out and trade for that 99 region, but I will tell you this. However this develops over the next 6 months, maybe as long as 12 months in the Dixie, it's likely going to be setting up a very big decline in the Dixie as we look out to 2023.
All right.
End of 2022 into 2023, I think we're setting up a big decline. However this resolves in this region over the next 6 months or so.
Huh. Okay. Well, that is really interesting. We really appreciate your perspective, Avi, on things, because like you say, you're right 70% of the time. I'd rather you be right 100, but nobody is. That's unrealistic.
I wish I could be, man. I wish I could.
Well, then you would know the future, and you're not allowed to know that.
Exactly.
Nobody is. So, again, tell us where we find you, how we connect with you on the web, your Twitter feed, all that good stuff.
Sure. I mean, the best place to get me, I'm always in my chat room at ElliottWaveTrader.net. That's 2 L's, 2 T's. And we have about 20 some odd analysts that cover worldwide markets. We cover everything from individual U.S. stocks through international markets to commodities, and so on and so forth. You guys can always ask me questions directly in that chat room. I'm always open to all questions.
All right. Sounds good. Really appreciate you coming on. We will talk to you again. If you got a question for Avi, shoot us an email, kl@kerrylutz.com. And don't forget, sign up for free newsletter, Financial Survival Network. Avi, a pleasure. We'll talk to you again real soon.
Thank you so much for having me on again.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.